When Donald Trump took office in January 2017, the American economy was already demonstrating steady growth after the financial crisis. Unemployment was gradually declining, corporate profits were high, and the stock market was on the rise. The new president promised to accelerate this process through radical tax cuts, large-scale deregulation, and a review of trade agreements. In the first 3 years of his first term, many of these promises began to be implemented. The Tax Cuts and Jobs Act of 2017 reduced the corporate tax rate from 35% to 21%, introduced temporary benefits for individuals, and stimulated stock buybacks by companies. According to preliminary estimates by the Brookings Institution, the law gave the economy a short-term boost, increasing GDP growth by approximately 0.7 percentage points in the first years. However, the long-term effect on investment and productivity turned out to be small, while the distribution of after-tax benefits became more unequal. The main advantages went to high-income households and large corporations. At the same time, the administration imposed tariffs on imports of steel, aluminum, and goods from China as part of a trade war that covered hundreds of billions of dollars in imports. These measures brought additional revenue to the federal budget but, according to modeling by the Wharton budget model, raised prices for American consumers and businesses, provoked retaliatory tariffs from trading partners, and required billions in subsidies for farmers. The overall trade deficit did not shrink substantially, it even grew by the end of the term, and manufacturing production did not return to the United States in the promised volumes. Despite this, until the start of the COVID-19 pandemic, the economy continued to show strong performance. Real GDP grew at an average of 2.527% per year. Unemployment reached 3.5%, the lowest level in half a century, and the S&P 500 index rose about 68% from the inauguration. Real wages for non-supervisory workers grew by 9.6% in inflation-adjusted terms, continuing the trend of previous years. However, structural problems already emerged during the first term. Federal debt held by the public grew from $14.4 trillion to $21.6 trillion, or by 50%, and its share of GDP rose from 76% to 100%. The budget deficit increased every year before the pandemic, and in fiscal year 2020. Due to the pandemic and stimulus packages, it reached a record $3.1 trillion. The pandemic became a turning point. In March-April 2020, the economy lost 21.9 million jobs. The unemployment rate soared to 14.7%, and GDP contracted by 2.2%, the sharpest decline since the Great Recession. Although the CARES Act stimulus helped the recovery and corporate profits continued to set records, the net result of the first term was negative in terms of employment, a loss of 2.7 million jobs. Many experts note that the administration inherited a strong momentum from the previous administration, while its own measures, such as the repeal of the individual mandate in the healthcare system, led to an increase in the number of uninsured people by 3 million. By the start of the second term in January 2025, the economy was again in a relatively healthy state, inheriting low unemployment and recovery after the pandemic. However, new initiatives quickly changed the picture. In April 2025, large-scale tariffs were announced. Dubbed Liberation Day, rates on imports from China rose to 60%, and universal tariffs affected most trading partners. Although part of the measures were later softened to an average level of about 1,017%, the effect was tangible. Customs duties brought an additional $118 billion in fiscal year 2025. But according to estimates by the Yale Budget Lab and the Economic Policy Institute, they increased annual expenses for a typical household by $10,001.700 due to higher prices for food, clothing, cars, and construction materials. Inflation, which had already been declining, received an additional push of 0.507 percentage points. And the Wharton budget model forecasts that even after all adjustments, such tariffs could reduce long-term GDP by 56% and real wages by 46%, with lifetime losses for the average household of about $22,000. In July 2025, the One Big Beautiful Bill was passed, extending the expiring provisions of the 2017 tax cuts and adding new benefits. According to Congressional Budget Office estimates, this package will increase the national debt by another $3.4 trillion over the next decade, while simultaneously cutting spending on Medicaid, nutrition programs, and clean energy. As a result, income inequality after taxes and transfers grew. The bottom 99% of households lost an average of about 1.2% of disposable income by 2027, while the top 1% received a net benefit of nearly $5,000 per family. The federal budget deficit in fiscal year 2025 amounted to $1.8 trillion, with a forecast for 2026 of $1.9 trillion, while interest payments on the debt for the first time exceeded $1 trillion per year. Despite these challenges, the economy in the second term demonstrates resilience. In 2025, real GDP grew by 2.2% year-over-year, slightly below 2024 but above some early year forecasts. The third quarter showed strong growth of 4.4% annualized thanks to private spending and investment, but the fourth quarter slowed to 1.4% due to the technical effect of the government shutdown in October-November. Unemployment rose from 4.0% to 4.3% by January 2026, and job creation slowed sharply to only about 180,000 new jobs for the entire year of 2025, one of the weakest figures in recent decades outside of a recession. At the same time, the S&P 500 index rose 14.8% from the inauguration, while private investment and consumer spending remained relatively strong, supported by expected tax refunds and lower interest rates. The policy of mass deportation and reduced immigration also had an impact. Net migration in 2025 turned negative for the first time in decades, which reduced labor force growth and consumer spending by approximately $60,110 billion over 2 years. According to Brookings estimates, the reduction in the federal workforce and the chaotic implementation of tariffs added uncertainty, increasing recession risk early in the term. Although the economy has so far avoided it thanks to a strong private sector and the artificial intelligence boom. In the global context, the tariffs led to a reorientation of trade flows. Part of the imports from China shifted to other Asian countries, but the overall U.S. trade deficit did not shrink substantially. European and Asian partners responded with their own measures, which slowed global growth and complicated supply chains. Long-term forecasts from the CBO and Wharton highlight the risks. Growing debt in some scenarios, interest payments already exceed defense spending, could crowd out private investment, while rising inequality will slow demand growth. On the other hand, supporters of the policy note that deregulation and the extension of tax benefits support business confidence, while tariffs protect certain industries such as steel and automobiles. In the end, Trump's impact on the American economy remains the subject of active debate. Short-term indicators often look positive thanks to inherited momentum and stimulus measures. However, long-term effects, rising debt, increased inequality, and structural distortions from tariffs create challenges for future generations. The U.S. economy demonstrates surprising resilience even under the pressure of these policies, but experts from different ideological camps agree that without adjustments to the fiscal trajectory and trade strategy, risks to living standards and global competitiveness will only grow.